Hello, hello. I'm Marin.
And I'm Edward Harrison.
Happy to have you here today. We have a special show for you. And today, on this very, very special episode of Boom Bust, we're focused entirely on the subject of oil. And to help us with today's discussion, we've invited 4 guests to weigh in on various topics surrounding the black gold commodity, and you definitely don't want to miss a moment. So let's get to it. Boom bust time, everyone. Now, first up, we have Marin Katusa. Marin is Chief Energy Investment Strategist at KC Research, and he's also Managing Editor of KC Energy Confidential and The Colder War Letter. Marin also authored the book, The Colder War, so I think we might have a little bit of Cold War stuff in there. Next up, we have Daniel Alpert. He's a regular here on Boom Bust, and Daniel is a former partner of Oppenheimer and current managing partner at Westwood Capital. Now, Daniel has more than 30 years of international merchant banking experience, and he can certainly hold his own on any panel, so we are very lucky to have him here today. Thank you for being here, Daniel. Up next, we have Phil Verleger. Phil is joining us today from Aspen, Colorado, where he is owner and president of the energy and commodities consulting firm PKVerleger. Now, Phil is also a former staff economist on President Ford's Council of Economic Advisors. And finally, rounding out this fantastic panel for today, we have Rob Barnett. Barnett specializes in energy sector economics, environmental policy strategy, and EPA regulations, and he is a senior energy economist at Bloomberg Government. And as always, joining me today is the fabulous, the one and only, my partner in crime, Boom Bust producer, Mr. Edward Harrison. How you doing today, Ed?
Very good.
Now, we're pretty excited, and I don't want to waste a moment of any of the good stuff, so let's just dive right in. Now, I'm going to direct this first question at you, Daniel, but I do want to say to any of the other panelists, feel free to chime in at any time or interrupt if you must get your point across. We want a healthy and preferably fierce debate today, so bring it on, fellas. We definitely want to see it. Okay, Daniel, first up. Now, in 1971, Richard Nixon took the U.S. off the gold standard and set in motion a massive devaluation of the U.S. dollar. Now, in an effort to prop up the value of the dollar, Nixon negotiated a deal with Saudi Arabia that in exchange for arms and protection, they denominate all future oil sales in U.S. dollars. Now, subsequently, the other OPEC countries agreed to similar deals, ensuring a global demand for U.S. dollars and allowing the U.S. to export some of its inflation. Now, this was obviously a pretty crafty deal on the part of Nixon, but my question is this. When will countries stop buying and selling oil in U.S. dollars, and does it matter? Daniel?
First of all, I don't think it'll happen anytime in our lifetimes. The notion of where demand comes from for energy is going to still be concentrated in the largest economies, the largest of which is the United States. In order to have oil redenominated in another currency, you're really going to have to break the role of the U.S. dollar as reserve currency. There are those out there who believe that that's going to happen in a sort of natural transition over a period of time. There are those who believed at one point that the euro could actually supplant the dollar. And there are people out there who actually think that if we wait long enough, the renminbi will be a reserve currency in the world. I don't believe any of those things are going to happen in a time frame that's worth actually thinking about or considering. Could it happen 20, 25, 30 years from now? Sure. But as a practical matter, that's not something we should be focused on.
Now, the rest of the panel, Marin, I see you furrowing your brow there. Do you agree with what Daniel's saying? How do you feel about this?
Not at all. It's already started. If you look at Iran, they're trading in oil in non-U.S. dollars. You look at the largest ever deal, $400 billion between Russia and China for the natural gas deal. I can assure you that the Russians and the Chinese are not going to be doing that in U.S. dollars. Go back to when the French were doing the oil for food program with Iraq in the early 2000s. So it's already started. So the comment that it hasn't happened yet is completely false. Now, I do agree it's going to take many years in the Colder War for this to play out, but it started already.
That's interesting.
The notion is, though, it's going to continue to be indexed in U.S. dollars, whether or not transactions are executed in another currency.
Now, Phil, I want to direct this next question to you. Why is the price of oil falling?
Very simple reason. the troika of Middle Eastern countries, Kuwait, Saudi Arabia, and the United Arab Emirates, have come to the realization that they need to defend their market share. And they are going to defend it. And so we are now having probably the third oil price war since 1985. These countries have a market share of 18 million barrels a day, plus or minus. They are the low-cost producers, and they are acting like a dominant firm monopoly. They are defending their market share, cutting the discounts increasing the discounts they offer to refiners, so that refiners will be sure of making money no matter what happens to the outright level of prices. And they're going to keep the pressure on until about 2 million barrels a day of oil is cut from the market by some other countries. And there's nothing personal in this. It's strictly business, and this is just a plain, good old-fashioned price war.
Now, actually, Rob, I want to throw this one to you. Now, there's this old Wall Street adage that when everyone gets to one side of the boat tips over. So, is oil oversold here?
Well, look, I mean, at $80 a barrel, roughly what we're flirting with right now, you know, I think the market is bearish. I agree with Phil that there is, you know, downward pressure right now. I would attribute it to other factors as well. I mean, look at the role that the U.S. Is playing in bringing supply to the market these days. It's a global market. U.S. has really come about as a major force in the last few years.
And I agree with that. What I was saying is that the troika countries, which have the lowest cost of production, say a tenth that of the United States, have utterly no intention of giving up any market share to the United States, to Canada, or to anybody else. They're going to keep their market share.
And don't have to because of their cost of production. The fact of the matter is that you can talk about where the supply is going to come from because they're going to do that, and I totally agree with you. The issue, of course, on the other side is what is relative demand? What is demand relative to aggregate supply? And I think you can't avoid coming to the conclusion that supply of energy across the board, let's not just limit it to oil, has increased at a more rapid pace than demand, even despite the enormous additional demands that have been created for energy by the emerging countries, which everybody thought would rise to the moon, but has plateaued at a level that is indicative of a somewhat different environment than people expected to see by this time.
Dan, speaking of that, do you think that China's rebalancing is having a positive or a negative impact on the oil market at this point?
Well, in theory, China's overbuilt both infrastructure and plant capacity relative to global aggregate demand for output. To the extent that they improve their domestic consumption, that would help both not just oil, but would help everything across the board globally in terms of rebalancing what is clearly an oversupply of more than just oil. You're talking about excess labor, excess productive capacity relative to aggregate demand, simply because the Chinese have not been consuming and have been, we've been enduring a 52% savings rate in China, which is unfortunately creating a huge glut of supply relative to the total consumption. So if anything that we can do to get Chinese consumption or emerging market consumption up is going to be beneficial not only to oil, but to pretty much everything else in the global economy.
You know, Philip, I want to ask you, where do you see sweet oil spreads heading in the medium term? You know, given all the excess sweet crude that's out there right now, that the shale drillers have really supplied us with, you know, what's going to happen?
Well, we right now have a surplus of sweet crude. 10 years ago, we thought we'd have a surplus of heavy crude. And this is economics.
It's true.
What will happen is that firms will build facilities to convert that sweet crude to products. In fact, it's much easier than people think. The heavy crude is a problem. You can't process it. In 2008, we had plenty of heavy crude, but we had no refineries available that could produce diesel fuel, so prices went to 140. A refinery that can process heavy crude can process sweet crude, and so with some adjustments and minor expenditures, and we're seeing that in many of these refineries, that crude will get absorbed.
Now, Marin, I kind of want to move on here to fracking and kind of development. We'll change directions a little. You know, 90% of the increase in U.S. production since 2010 has come from 6 shale oil sites in the U.S., just 6. So where is the break even for the fracking industry? You know, I hear numbers as high as $90, as low as $75. At what price does shale run into problems?
So we first have to understand that all shale formations are not equal. So let's start in the Marcellus on the East Coast. The gas companies there are making money under $2 per MCF. So that's half of essentially what Henry Hub's going for. So it's about a local market and infrastructure. If you look at some of the sweet spots in the Eagle Ford or in the Bakken, the right companies who've really improved their technologies. Plus, remember, we've had the benefit of cheap money, and we're going to see that continue with the Fed's movement today. But, you know, there's a lot of companies in the Bakken and Eagle Ford or in the Montney up in Canada that can make money at $65 per barrel of oil. Now, of course, there's certain companies that are on the outer skirts, and the debt's going to kill them, that are going to really drown on debt at $80 oil. So it really comes down to also what their composition of condensate or NGLs and natural gas and of course oil is. So the best producers can make money at $55, $60. Below that, it's going to be very tough for any of the North American unconventional shale plays to work. Absolutely.
Now, Rob, I want to get you in here too, because I want to ask you, you know, fracking depletion rates, they say that they're essentially never going to happen. There's so much of it, they're never going to go anywhere. But, you know, does it concern you that this cheap shale oil production could really put us in a place where we're in trouble and we're going to regret some of our decisions down the line?
Well, I think with the fracking technology, it really turns the production of oil and natural gas into more of a manufacturing process. And so, you know, you go out and you refrac wells, and certainly you're going to need price support to do that. And, you know, if you start to go below 80, you'll start to see some of the marginal producers maybe pulling back some. But, you know, as long as you have the global oil price in the rough neighborhood we see it today, I think you'll see continued production. And, you know, I see no evidence that the decline rate is really going to be a major problem. I mean, look at where production is today. We're not too far from crossing the all-time crude oil production peak in the United States.
It was a terrible mistake, and we're working very hard to make up for it.
Once again, we put something on the air. It's a flat-out lie.
Have you ever had sex with Governor Rick Perry?
No, wait. Do not answer that. I want you to watch what we're about to do, because you've never seen anything like this on television. What we need is to question more and to keep it uncensored, real and raw. My simple mission is to change the globe. I'ma do it with this passion and fire and tone. These words are hard hitting.
Right from the scene. First-rate news and eye-gripping pictures. On our reporters' Twitter and Instagram. To be in the know, follow us online.
Business news, reviews, economic ups and downs from the finance hub of Moscow to London, New York, Shanghai and the rest of the globe. Join me, Katie Pilbeam, every week on RT.
Welcome back to the show. Now today on Boom Bust, we've amassed a pretty spectacular group of panelists to talk about oil. So on that subject, you know, Iraq is one of the world's largest producers of crude oil and is known to have a fifth of the largest proven oil reserves on the planet. But due to political disputes, oil production has fallen. RT correspondent Paula Sleer has more on this.
There's obviously a lot of geopolitical conflicts in the world today, and no country evokes the nexus of oil, politics and money quite like Iraq. It begs the question, why would the American President Barack Obama, who was elected on ending the war in Iraq, now want to escalate America's involvement in this country? And this seems to suggest that not doing so in some way threatens America's standing in the Middle East and American oil security. Some facts: the oil reserves in Iraq number more than 140 billion barrels. Iraq has the fifth highest number of proven oil reserves in the world. According to the U.S. Department of Energy, and this is an estimate from 2003, there were only 112 billion barrels of oil in Iraq. But either way, it does point to how hugely significant oil is in this country. Recently, there were weaknesses in oil prices. Now, this was because of the supply coming online due to successes with shale oil extraction, and also because of the drop in expected global demand. And this came as the economies in China and in Europe weakened. At its peak, Iraq pumped something like 2.6 million barrels of oil a day, and only recently was it able to return to those levels. In 2012, according to the International Energy Agency, Iraq was ultimately able to increase its levels to some 6 million barrels per day. Now, this means that the supply of oil coming from Iraq and who controls it is extremely important. If you look at the oil that is controlled by ISIS and ISIL in Iraq and in Syria, what is happening is that often that oil is being sold to middlemen who transport it illegally across the border into Turkey. Analysts suggest that militants are making in the region of $3 million a day from the oil that they sell in Iraq and in Syria and that they have control over. But the Turkish authorities have launched a multi-layered crackdown that is aimed at reducing the illicit trading of oil. And certainly in the last 6 months, we have seen that oil smuggling was a bigger business half a year ago than it is today. Paula Sleer, RT, Iraq.
Yes, now, as you mentioned, that was RT reporter Paula Schleer reporting for us from Iraq. But, Marin, I want to direct this question at you. So what about Iraq? You know, we're seeing intensifying Sunni Shiite warfare throughout the Middle East right now. So if Iraq's production were to stop, there would be no spare capacity in rising oil prices. They likely would slow global growth and energy consumption. So is this something that we should be scared of?
No. Definitely. I've spent time in Iraq and Kurdistan, and I look at what's going on there, the lack of infrastructure. Look at Janelle, where Tony Hayward, who used to run BP with the Rothschilds with Janelle, you know, they haven't had that much success there, and this is just the beginning. There's going to be no near-term solution to what's going on in Iraq, and also the spillover effects, especially with the Strait of Hormuz or perhaps the Strait of Malacca. There's a lot of issues there, and I don't see it coming to a peaceful end anytime soon. And even if they were able to drill, these are very expensive wells, and so far the success rates haven't been good for the guys trying to drill the wells so far. So it's a serious issue, yes.
Philip, I think that you might disagree. I heard you jump in there and say absolutely not. What's the story with that?
Well, I thought you said Phil, and I just am, okay, I've been following the oil market for 30 years. I've taught at Yale and taught at other universities, and I consult. Iraq is becoming irrelevant, and Iraq is becoming irrelevant thanks, one, to the shale oil, two, to the desire of what I call the Middle East Troika, Saudi Arabia, Kuwait, UAE, to build their market share and sell more oil, and three, the fact that the world's demand for energy is shrinking. Now, we can be talking about oil, but the really elephant in the room is deflation. And Christine Lagarde talked about it at the fund bank meetings a few weeks ago. The Fed talked about it today. Europe is sliding into deflation. And if you go read the good articles on deflation, and there are not many, Paul Krugman's probably got the best, the world looks like it could be sliding into a situation similar to what Japan slid into. If that were to happen, instead of consuming 120 million barrels a day in 105 million barrels a day in 2025, as many project, we could be consuming 80. That's the trend that Japan established in a deflationary environment, and that looks to be where the trend in consumption is going. Every year we come out. Go ahead.
Please. I don't know that we're really going to see a decline in barrel consumption more than we will a decline in price. I mean, I completely agree with you. The elephant in the room is deflation. I wrote a book on it called The Age of Oversupply. The Iraqi situation. The Iraqi situation is a blessing in disguise for the other producers, right? I mean, because as a practical matter, if Iraqi supply was on the market, we would be in a very, very different price environment.
That it would be there would be a 2 in front of the price of oil, and there would be only 2 digits.
Well, speaking of conflict, by the way, there's the conflict in Ukraine, and I think that, with sanctions with Russia, the question that a lot of people are asking now is whether or not what's going on in terms of Saudi Arabia has anything to do with a new colder war, whether or not the United States and Saudi Arabia got back together in some capacity and created this situation. Do you think that there is a new colder war going forward? Why don't I ask you, Rob, what's your thinking on that?
I'd be pretty skeptical that the United States is actively coordinating with Saudi Arabia or OPEC countries to try and manipulate outcomes in the global oil market. Just skeptical that such things would occur.
I have to totally agree with Rob on that. I mean, the Saudis run their oil marketing business as a commercial endeavor. And their marketing people from Saudi Aramco are now busily trying to line up more buyers. They do not. They go out for to cultivate customers, to keep their customers happy, so they sell more oil. Their production level is determined entirely by what their customers tell them they need, plus their own internal needs. They don't adjust the valve to a certain set level. And by leaving this as a commercial endeavor, they've managed to build up the 3rd largest foreign exchange reserves in the world. And they're right now doing this as a customer marketing effort. They see the Canadians working hard to market oil. Canada's working with India. So just today, the Indians and the Saudis have agreed that the Saudis will store a large volume of oil in India, build some new storage facilities, and, oh, by the way, sell India a great deal more oil. The Saudis, as far as oil goes, are strictly a commercial endeavor.
By the way, Marin, despite the price cuts that the Saudis have given, we were hearing that Chinese refiners are favoring supplies from Oman and South America over Saudi Arabia as their prices relative to output are more competitive. How will Saudi Arabia fare in terms of their economy and in terms of their government budget as a result of this decline?
So the #1 buyer of the Saudi oil moving forward, and even today, will be China, and will continue that. So where the America used to be the largest consumer, now that whole paradigm shift has changed. So, when you look at the wells, when I was in Kuwait, some of these wells that are existing are still pumping out 30, 40,000 barrel fields that essentially $15 is break-even point. So yes, the budget, when everyone talks about what price does Saudi Arabia need in oil to balance their budgets, remember, they got large reserves that they can dip into, and this is all about percentage market share. So it will continue, and I see further downward price in oil. But at what point is the stabilization point? And I think you're going to see down to about $65 oil here in the near term. But it will continue in the interests of Saudi Arabia and China, and also, in the earlier comment about Iraq, but China's importing a lot of oil from Iran, and that also will continue. So there's a lot of variables moving around here very quickly.
Now, I actually want to direct this next question at the whole panel. I want to talk about alternative energy. This is an interesting point. And, in terms of alternative energy sources, you have nuclear, you have wind, you have solar, and they all have their purposes, and they have their pluses, and they have their minuses. But how do we see these comparing cost-wise to oil and gas right now?
This is Rob. I'll take the first pass at
Rob,
that.
this is
Look, you're really comparing apples and oranges in a lot of ways. you're talking about liquid fuel mainly used on the transportation market versus, you know, sources of electricity. I mean, I guess at the point where you increasingly see, you know, the Teslas of the world, the Nissan Leafs of the world kind of gaining market share, then it will become a more relevant question. Electricity is currently priced at the equivalent of about $1 a gallon per gasoline, but for consumers, you pay a lot more upfront in your capital costs for the vehicle to receive that price. So, I mean, right now, I think I wouldn't generally think of those two markets as being highly competitive.
Well, let me, two comments. One, Bloomberg had just a mind-boggling graph this morning on the cost of, the declining cost of solar electricity versus natural gas. And one of the panelists is from Bloomberg, and all I got to say is it really woke me up. But the second comment is it's in natural gas. What we're going to see in the United States is a gradual substitution of natural gas for liquid fuels because, as one of the previous panelists noted, in the Marcellus Shale, they're making money at $2 a thousand cubic feet, which is equivalent to $12 a barrel. And what you're going to see is more and more transportation companies substituting natural gas for oil, particularly in trucks. The railroads are looking at it, but they have a 30-year payout, and they're just not sure whether it's worth the investment yet, and they tend to be slow. So what you're going to see is oil getting pushed out of the market by this low-cost natural gas in the United States. You'll also see it
natural gas. Yeah, I'm sorry. Go ahead, please.
Go ahead. No, go ahead.
No, I'm saying natural gas is, in fact, the new alternative energy. You're looking at a source of fossil fuel, of course, and so from the standpoint of people who have environmental concerns, obviously depleting fossil fuel is not in keeping with the purpose of environmentally friendly energy sources. But at the end of the day, there's so much of it that it's basically displacing and devaluing all other forms of alternative energy.
I'm sorry, I got to wrap you guys up. Thank you. You are one of the politest panels we've ever had. It was so nice having you, all of you, Marin, Dan, Phil, Rob. Thank you guys. You should have seen our gold show. Colin Roche and Peter Schiff were about to throw down, but we appreciate having you guys here. Thank you so much for all your insight. That's all the time we have for now, but thank you for watching. Please do tweet at us. Check out our Facebook page. You know the deal. Thanks for watching Boom Bust. See you tomorrow. Bye-bye.